The only thing to get right as an option seller is the position sizing. So you can be a terrible option seller. You can have no idea what you're doing, no analysis. But if you keep your position size small, you'll be making way more money, way more consistently than someone that knows what they're doing but taking big positions. So basically, position sizing will make or break you. Doesn't matter what level of knowledge you have. And I want to go over exactly how I look at position sizing and how I make sure my account can handle basically somewhat of a worst case situation. So this is everything about the position size, specifically for futures options. Now, how much is too much? And for me, the position size, I look at the buying power, or in my case, the margin requirements for interactive brokers. And we'll go over a few examples after we end up with the slide. So using over 60% of the account in margin requirements is, this is the absolute upper limit. I should have put, 61%. Up to 60% is the absolute upper limit for myself, because margin can expand. You can have unrealized losses. So you need to have at least 40% of your account available to either do something for the position or just have the cash sitting in there. So 60% is the most, and having one position that uses 30% or more of the account in margin is too much. Again, I should have put 31%. I usually go up to 30%. Sometimes the position can inflate to 31, 32%, or even 33%. It's not a big deal, but I'm trying to keep it at 30% or under for a single position. And it's really, really important, the 30% number. So people can just have one position that takes 70 or 50, 60, 70% margin requirements of their account all on one position. And sure, the position can make a lot of money for them, but at the same time, something happens, something goes sideways, you have absolutely no way to protect yourself, even though the price is still really far away from your strikes. This is the kind of worst situation to be in, where there's short-term volatility, but because you're out of margin requirements and the unrealized loss is eating into your leftover liquidity, then you're just forced out of the position. And this happens quite a lot. Now, what most traders ignore, and this is the unrealized drawdown calculations, they lower liquidity crucially, right? So people just look at the payoff diagram of a position right at expiration, and it happens with the 112. Oh, if the price drops, we make even more money, which is completely untrue. It's only true at expiration. During the position, many things can happen. Volatility can change. This is something we'll be taking a look at today. And margin requirements can expand up to a time and a half in extreme cases, even a bit more, but depending on the broker you use. Again, I use interactive brokers, so their margin requirements by default are pretty high. So up to one and a half times is the most I've ever gotten. And I think it was in COVID in 2020 in March. So how to properly calculate the position size? First, we need to analyze the profile of the position and estimate the drawdowns, how much money the position might lose if it gets to our short strike. Now, we need to take into account that margin requirements can increase as well by a time and a half. And we need to combine both calculations to see if the account can handle an extreme situation. And again, we'll go over an example in just a second. There are some other tricks to control margin requirements. You can buy cheap calls or puts with less days to expiration if margin expands, and this will lower your margin quite substantially. I'll give you an example of this as well. And you can roll into the next expiration to lower margin as well, but this is not as effective. The most effective thing will be probably buying the cheap calls or puts. Let's take a look at crude oil, for example, 96 days to expiration. Let's just go sell a put with 52 days to expire, or with strike 52. This is just at the expected move. So if we just sell this one, and let's take into account a $100,000 capital. So we have a 100K account, for example. What will happen if the position, for example, if with one contract, if the price gets to our strike, and I'm not looking what will happen at the expiration, which is this smooth line. I'm looking at the dotted line. So this is what will happen today. If price drops without change in volatility, the position will be down about 2.7K. So we'll be down about 2.7% on the account if price drops today. Now, it's very unlikely, but I'm here to calculate the worst case scenario and make sure I can handle it. Because believe it or not, if you trade for enough years, this worst case scenario will happen, right? And you need to be ready, because this is basically what you're always preparing for. So we can probably easily go for a few more contracts. It only takes about $4,000 in margin requirement, and we get a nice credit. So we probably can go 3, maybe 4 positions. So here we collect about $3,500 in credit, only about $17,000 in margin, so 17% of the account margin. And if we take a look at what will happen if the price gets to our strike, we'll be down about, let's call it 11,000, so down 11% on the account. So this is something the account can definitely handle if this is the only position on the account, right? Even if there's another position, this should be quite okay. Margin requirement can go up from 17,000, let's call it goes up to 30,000, right? So 30% of the account is tied up in margin for this position, and we have a drawdown of 11,000. So we're looking at about 41% of our account being either tied, or I think it's 30% of the account being tied in margin, and then the unrealized loss takes another 11% out. So account can easily handle it. We have 100K, 30K is locked, and then we have another 11,000 in liquidity that is wiped. So we have effectively an $89,000 account with a $30,000 margin position. So not a big deal, we can handle it. This is a position to open. I currently have a similar position. Now the next thing to kind of check is to see what will happen if we also play with volatility, because volatility is a big factor. You have to take it into account. Now in this case, and this is the exact same position, this is a 52 put strike on crude oil, 96 days to expiration. The cool thing about OptionStrat is you can change the blood volatility and kind of see what's going to happen. You can also play with the dates and see what the diagram will look like. So currently this is the payoff diagram as of today. Same as we just looked at the interactive brokers. Now the thing is, with crude oil and most commodities, volatility goes up if price shoots up, not if it goes down, right? So if price will really shoot down really hard, volatility might go up, but not as much, right? But regardless, this is something we need to take a look at. So let's put 4 contracts here as well, about the exact same numbers here. So if, for example, volatility goes up just a few points, right? Or it can go actually quite a bit of points. See what happens now. So now we're going to be down $15,000. Margin is going to expand even more probably. Now this margin, I'm not sure exactly how they get it here, but margin will likely probably going to expand to like $40,000, give or take, from our initial 17 to, let's take a worst case scenario, even though it's way more than a time and a half, $40,000, and we are down 15,000. Right, so the account can still handle that, right? And again, this is a pretty extreme situation, right? And I'm talking about if price moves so quickly that you cannot react. Usually, obviously, you would react way earlier, even if the position is down 100% of credit, which is around here. You would need to do something with a position to kind of save it. But this is how I check if it's kind of safe to do it. And you can do the same thing on, for example, on the ES. Let's go to December expiration, see how many days we can get out. See here, 99 days. And let's see if we're selling the 5100 put. Can increase the range. So you can see here we'll be down $14,000 on just one contract. And we know with the S&P, if price drops, volatility can easily double, right? If volatility doubles, you're going to be down 30,000 on one contract. This is a pretty bad trade to take, right? So you're better off having a closer put strike where you collect way more credit. And also, obviously, in this case, you definitely want to be able to control the position way before something happens. So for example, if price is down somewhere over here and you're already down X amount, you can lower margin, which is the biggest important thing really. You can lower margin by buying cheap calls and puts. So I have a put here, 52, that I opened up a few days ago. So let's go ahead and just show you exactly what kind of margin it takes. It takes about 17.7K margin. Now this is a demo account. So what happens if I go to a lower expiration and I'm going to buy a put? So let's say I'm going to buy 4 puts, right? So you can see it will take away 15,000 in margin. So basically, my margin will be around $2,000 or $2,500, $2,600 only, right? Because this will lower my margin, okay? Because I'm basically buying it's not the exact same strike because these are different expiration contracts. But this is quickly will lower your margin. Yes, it will cost you money. It is what it is. And you can play around with it and choose different strikes. You can maybe go for just 2 contracts. It will still lower your margin by over half, and it will cost you much less, right? So this is how you would kind of approach position sizing. This is how I would always do it. I don't really care how much credit I collect. I care about what happens if price goes to one side or another, and if my account can actually handle it, especially in directional trades. When it's neutral, it's way easier, and it depends also. But with directional trades, this is definitely how you want to be able to look at what's happening and just be able to aggressively manage your position. So this is it. Hopefully this video was useful. I know it's really a bit unconventional, but this is how I do things, and it's been working out for me pretty well for the past almost 10 years at this point. So I'm pretty happy with the results, and let me know if you have any questions in the comments. Thank you so much, and I will catch you in the next one.